Among the stunning oversights by former FTX CEO Sam Bankman-Fried is that he was unaware of $8 billion in liabilities, telling the Financial Times that it was, quote, accidentally extended to his trading firm Alameda Research. Joining us now with more is Seth Wilks, Senior Director for SME and Government Relations at TaxBit. Seth, thanks for joining us. So could some good forensics accounting done well to prevent the collapse of FTX?
You know, it's an interesting thing. I'll put my auditor hat on for a moment, because when you think about being audited, there's a concept called materiality where, depending on the size of the business, you look at certain accounts that are over a certain threshold. And an account over $8 billion, it just doesn't make sense. When you think about the smell test, there's just no way that an audit firm could possibly have missed something like this. And I know, Sam Bankman-Fried made the comment that they had done a U.S. GAAP financial statement audit, but I think if they had done a full audit of all of their entities, there's no way something like this could have passed. So my guess is that that statement was likely specific to a smaller entity within the organization, but it did not apply to the overall org.
So FTX is a non-U.S. entity, but filing for bankruptcy protection in the United States. Can the IRS get a hold of their financials?
Absolutely. I mean, once it starts going into the bankruptcy process, there's a lot of disclosure that's going to happen. And obviously, Sam Bankman-Fried has stepped down, and they brought in somebody else who went through another very famous blow up back in the early 2000s with Enron. So I think they're bringing in people who understand how to do this. There's going to be a lot of disclosures. And frankly, it seems like there's going to be a lot of shocking news that will likely come out of these disclosures.
Yep, that's John Ray III, formerly who oversaw the Enron bankruptcy, now stepping in as CEO of FTX. So earlier this month, the IRS's Criminal Investigation Division chief said it's building hundreds of crypto cases. Many involve off-ramping transactions and people being paid in crypto and not reporting that income. What's the best way to make sure traders are getting their taxes right and avoid IRS scrutiny?
Yeah, so I think that right now, given the, lack of regulation with exchanges having to report on transactions, it really is still on the shoulders of most taxpayers to have to go out and do these calculations. And so I think that what's really happened over the last several years is that people have made a good faith effort, but it's really complicated unless you're using software to help you do it. And I think people just kind of give up. And so I think as we move into the future with new regulations coming out, like from the infrastructure bill that was passed last year, we're going to see a lot more better reporting coming out of exchanges, which is going to help taxpayers to do a better job complying with these laws.
And the IRS is focused a lot on crypto traders, but are they missing the ball here? Should they really be going after crypto exchanges?
That's a great question, and that it's fair given all of the circumstances that have happened over this past year with a lot of the lending institutions as well as FTX now. But I do think that there is a mix of scrutiny that needs to be had on both sides. I think it was back in 2019, or there was a report recently that said that only about 100,000 people reported crypto transactions in 2019. Now, given that roughly 20% of the U.S. population, the adult population, has been involved in crypto, that seems incredibly low, which means there's a huge tax gap in reporting for individuals as well. And so I think both deserve scrutiny.
All right, so crypto is in a bear market. What should people know when reporting their taxes in April?
Well, a bear market does present some opportunities. In the securities world, there are these rules called wash sell rules, which basically prevent you from, selling an asset at a loss and then buying it back within 30 days before or after that sell. Because that's very specific to securities, it does not apply to cryptocurrency or digital assets, which means that there's an opportunity for you to be able to sell out of an asset that's in a loss position, recognize those losses this year, and you can offset other gains, potentially from your stock trading or real estate portfolio, or you can offset up to $3,000 of ordinary income. So there is an opportunity, even in a bear market, to be able to take advantage of tax loss harvesting opportunities.
All right. And what are the positives and negatives of holding taxable accounts versus a tax sheltered account like an IRA?
Well, a tax-sheltered IRA, really the benefit of that is that there's not really annual reporting at the individual level. And so, an IRA can be buying and selling crypto throughout the year, and there's really no reporting that has to be done by the individual. If you're buying and selling on an individually held account, then that activity has to be reported. And the IRS has been investing very heavily in tools to be able to help them to better understand what people are doing, both on-chain analytics as well as things like John Doe summonses that have been sent out recently over the last year to exchanges like Kraken and more recently SFOX and Circle.
Awesome. All right, folks, check out CDTV and CoinDesk.com for more tax stories happening all this week for Tax Week. Seth, thanks so much for joining us. That was Seth Wilks from tax and accounting solutions provider TaxBit.